Welcome to the deep dive. When we think about the big financial disasters in American history, 1929, well, it's kind of the original, isn't it?
Oh, absolutely. It's the benchmark. The moment everything changed, Wall Street went from this, distant place to something that could wreck the whole country.
Exactly. It's burned into the national memory, maybe even more so since 2008. It feels like it's achieved this sort of mythic status.
Right. But like a lot of myths, the nitty-gritty details, they often get smoothed over. We know Black Tuesday, we know the Depression followed, but the how and the who, that gets fuzzy.
And that's precisely what we're digging into today. We're doing a deep exploration based on Andrew Ross Sorkin's huge project, 1929. Took him 8 years, apparently.
Yeah, Sorkin, who wrote Too Big to Fail about the 2008 crisis, this is like the prequel. He wanted to write the definitive granular history of 29, put you right in the room.
So our mission here is to unpack that history, drawing on Sorkin's work, interviews about it, reviews, and really understand the mechanics of the crash, the human drama. But also, and this is key, look at the parallels Sorkin sees between then and now.
That's the crucial part. Sorkin is definitely sounding an alarm. He sees echoes of the roaring 20s in today's tech boom, the crypto stuff, AI, this whole feeling that, this time it's different.
The classic dangerous phrase. So the big question for us, and for you listening, is what can this deep dive into 1929 tell us about the potential risks we're facing right now?
Let's jump in. First off, how do you even write this kind of book about 1929?
Right. I mean, 2008, Sorkin could call up Hank Paulson, right?
Yeah.
Interview people who were actually making the decisions. But 1929, everyone involved is long gone.
Exactly. That was the massive challenge. He couldn't just rely on interviews. And the traditional historical sources, like big comprehensive archives for the main players, they often just didn't exist.
So like the diaries and memos of the big bank CEOs.
A lot of it, yeah. People like Charlie Mitchell, who ran National City, which became Citigroup, there just wasn't a central trove of his papers. Maybe they never existed. Maybe they were destroyed. Who knows?
Okay, so that sounds almost impossible. How do you get that inside the room feel without the main character's notes?
Well, Sorkin described it as a puzzle piece situation. It took incredible journalistic effort. If Mitchell's diary is gone, you find everyone Mitchell talked to. You hunt down their letters, their memos, hoping for a mention, a snippet of conversation.
So you're piecing it together from the edges almost.
Precisely. And apparently there was this moment early on, an archivist at Harvard basically told him, you'll never get the kind of granular detail you want for this period, which, just made Sorkin more determined.
Huh. Yeah, I can imagine. Like, challenge accepted.
Exactly. And his big breakthrough, it seems, wasn't finding some secret diary. It was realizing the value of legal records created years after the crash.
Okay. Like lawsuits and investigations?
Exactly. Depositions, testimony from civil suits, even criminal cases that went on into the 1950s, even the 60s. People talking under oath years later, recalling conversations, meetings, stuff that was never written down at the time.
That makes sense. People have to be specific under oath. That's where the detail comes from.
That's where the gold was. He talks about finding transcripts where someone's asked, what did you tell your wife that night? And then somewhere else, he finds the wife's deposition saying, here's what he told me. Suddenly, you have dialogue. You can build a scene.
Wow. That's like historical reconstruction. It makes it feel immediate, not like dry history.
Right. It gives it that thriller-like quality he was aiming for. And another huge find was related to Thomas Lamont.
The guy running J.P. Morgan at the time.
Yeah, effectively. In Lamont's personal boxes, they found these amazing transcripts. His secretary had apparently recorded, word for word, his phone calls and meetings with President Hoover, with FDR.
No way. Actual transcripts.
Actual transcripts. Not summaries, but the back and forth. The arguments, the panic. You hear it directly. That stuff is just invaluable for understanding the political dimension, the power plays happening behind the scenes.
Okay, so he found a way in. He pieced together the conversations, the mood. So what did that reconstructed picture actually look like? What were the mechanics driving this disaster?
Well, to really get 1929, you have to step back even further to the culture. There is this fundamental shift in how Americans viewed debt.
Okay, how so?
Before the 1920s, for a lot of people, taking on debt like a loan or buying on credit, it wasn't just bad financial sense. It was seen as almost a moral failing, a moral sin, Sorkin calls it.
Huh, that's a really different mindset than today. So people just didn't borrow much.
Generally, no. It wasn't the norm for consumer goods. That started to change around 1919. General Motors did something revolutionary.
What was that?
They started offering financing directly to consumers to buy cars. Buy now, pay later. That idea, applied to a big aspirational purchase like a car, it normalized consumer credit. It fundamentally changed how Americans shopped and thought about money.
And Wall Street saw this happening.
And they jumped on it. They saw this new cultural acceptance of debt and thought, how can we apply this to the stock market? This led to this explosion of brokerage houses popping up everywhere, almost like Starbucks, Sorkin says.
Making it easier for average people to get in on the action. The democratization of finance, they probably called it.
Exactly that language. Access, opportunity. But what they were really selling was access to incredible amounts of leverage. And the key mechanism was buying on margin.
Right. We hear that term a lot with 1929. Can you break down just how risky that margin system was back then? It sounds wild.
It was unbelievably wild compared to today. Now, you usually need to put down at least 50% cash for margin trading. Back then, an ordinary person could buy stock by putting down as little as 10% cash.
Wait, only 10%. So you put down $1 and you could borrow $9 from your broker to buy stock.
Pretty much. 10-to-1 leverage was common. Think about that. The market soared, 90% between 28 and 29?
Yeah, incredible run-up.
If you were leveraged 10-to-1, a stock only needed to go up 10% for you to double your cash. It created this unbelievably intoxicating feeling. Free money, almost. Everyone felt like a genius.
Until the music stopped. Because that leverage cuts both ways, right? That's where the margin call comes in.
That's the deadly part. Let's say you bought $10,000 worth of stock with $1,000 cash, borrowing $9,000 from the broker. The stock itself is the collateral.
Okay.
If that stock price drops by just 10%, your $10,000 investment is now worth $9,000. Your entire $1,000 cash cushion wiped out instantly.
Gone.
Gone. At that point, the broker issues a margin call. They demand you put up more cash immediately, sometimes within hours, to cover the loss and secure their loan.
And if you don't have the cash, which most people wouldn't if they were already stretched thin buying on margin,
then the broker has no choice. They have to protect themselves. They forcibly sell your stock at whatever the current market price is, even if it's plummeting.
which just drives the price down further.
Exactly. It creates a death spiral. A small dip triggers margin calls. People can't pay. Brokers force sell the stock. The selling pushes prices down more. That triggers more margin calls, and the whole thing just cascades. A complete, terrifying collapse.
And the technology back then couldn't even keep up with the selling pressure.
Not even close. The ticker tapes, the things spitting out the stock prices, during the worst days of the crash, they were running hours behind, sometimes 5 hours late.
5 hours. So people were making decisions based on prices that were completely out of date.
Total chaos. Imagine swarming your broker's office, desperate, trying to find out what your stocks were actually worth. Were you rich? Were you broke? Did you owe money? Nobody knew for sure in real time. It was the definition of a panic. Pure Wild West.
Okay, so you've got this incredibly unstable system, huge leverage, patchy information, a culture suddenly embracing speculation. It feels like a perfect storm waiting to happen. And Sorkin really zooms in on the powerful figures riding this wave, right? The titans of Wall Street.
He absolutely does. The book isn't just about numbers. It's about the personalities, the egos, the greed, the corruption that fueled the boom and exacerbated the bust. One of the central conflicts he highlights is between Charlie Mitchell and Senator Carter Glass.
Mitchell, again, head of National City. What did he represent in this drama?
Mitchell was the embodiment of the new, hyper-aggressive Wall Street. He built this huge machine-selling complex, leveraged investment products, investment trusts directly to the public, often playing fast and loose with the risks. He was all about expanding credit, pushing leverage.
And Senator Glass was pushing back.
Hard. Carter Glass was this very traditional, fiscally conservative senator from Virginia, kind of the Elizabeth Warren of his time, as Sorkin puts it. He despised what Mitchell was doing. He even coined the term Mitchellism to describe this reckless expansion of debt that he was convinced would ruin America. It was a real ideological battle over the future of finance.
But it went beyond just philosophical differences, right? The book details actions by these top bankers that sound, well, completely crooked by today's standards.
Absolutely. It wasn't just bending the rules. It was often outright corruption, just accepted as how things worked. Take J.P. Morgan, the most prestigious firm on the street. Sorkin found evidence they routinely kept these things called preferred lists. Basically, they'd offer powerful politicians and influential figures blocks of stock in hot new companies at prices below what the public would pay.
Wow. So basically, legalized bribery, keeping the politicians on side by making them rich.
Pretty much. It ensured the political establishment had a vested interest in keeping the Wall Street gravy train running. It wasn't technically illegal then, but the ethical implications are staggering.
And then there's the story of Richard Whitney, the president of the New York Stock Exchange himself.
Whitney is maybe the most dramatic example of the hypocrisy. Here's the guy whose job it is to ensure the integrity of the market. He's testifying before Congress, calling the NYSE a perfect institution.
But behind the scenes,
Behind the scenes, he's desperately trying to maintain this incredibly lavish lifestyle, fancy estate, fox hunting, the whole 9 yards, and to pay for it, he's secretly embezzling huge amounts of money. Over $1 million worth of securities stolen from clients, from the NYSE's own funds.
the head of the exchange was stealing from it.
Yep. When he finally got caught, it just shattered what little public trust was left. If the man at the very top was a crook, who could you possibly trust?
And this culture seemed to enable widespread market manipulation too, like those pump and dump schemes you hear about. Was that common?
It wasn't just common, it was practically standard operating procedure for the big players. They'd form these groups, called pools or syndicates.
Oh.
They'd secretly buy up tons of shares in a particular stock, often one that didn't trade much. Then the pool members would start trading shares back and forth among themselves very aggressively to create the illusion of high volume and rising prices.
To make it look like something exciting was happening with that stock.
Exactly. They'd basically paint the tape, as they called it. Seeing the price jump and all this activity, smaller investors, the public, would think, wow, this is the next big thing, and rush in to buy.
Homoing in.
Totally. And as soon as that wave of public money came pouring in, pushing the price even higher, the original syndicate members would quietly start selling off their shares at those inflated prices,
Pulling the rug out.
pulling the rug out. They'd cash out, make a fortune, and leave the general public, the suckers, as they were called, holding shares that quickly became worthless once the manipulation stopped. It was a calculated transfer of wealth.
It sounds so predatory. And the human cost, when this whole house of cards finally collapsed, it wasn't just financial, was it?
No, God, no. Sorkin really emphasizes the dark side. The aftermath was filled with ruined lives, affairs exposed, people going to prison, and suicides. Lots of suicide.
Like Jesse Livermore, the famous speculator.
He's the most famous example, yeah. Shot himself in the coat room of the Sherry Netherland Hotel. His story became symbolic of that whole high-stakes gambling culture crashing down.
And Sorkin connects this directly to his own family history, right? The story about his grandfather.
Yeah, it's a really powerful anecdote. His grandfather was just 11 years old in 1929, working as a messenger boy on Wall Street. And one day, during the crash, he saw someone jump out of a building window,
Oh, God.
witnessed it directly. And that image, that trauma, stuck with him his entire life. Sorkin says his grandfather lived into his 90s and never, ever bought a single share of stock. He kept his money under the mattress or in ultra-safe bonds.
Wow. That just shows the deep psychological scar the crash left on a whole generation. It wasn't just an economic event. It was a national trauma.
Absolutely. It shaped behavior for decades.
Okay, so we've painted this picture of 1929. The mechanics, the culture, the human cost. But the whole reason Sorkin wrote this, the reason we're diving deep, is because he sees disturbing parallels today in the 2020s.
Yeah, he's not subtle about it. He explicitly states he believes a crash is coming. He doesn't know when or how deep, but he sees the same patterns of excess, speculation, and maybe wishful thinking playing out again.
So what's the most direct parallel he draws?
It's the technology mania. That's the big one. In 1929, the revolutionary gotta-have-it technology was radio.
Radio.
Yeah. And the stock everyone was crazy about was RCA Radio Corporation of America. It was seen as this transformative technology that would change everything. People bought RCA stock not based on its current profits, which were modest, but on this grand vision of the future. The narrative drove the price into the stratosphere.
Okay, I see where this is going. The parallel today is
NVIDIA. And more broadly, artificial intelligence. AI is the transformative technology of our time, right? And stocks like NVIDIA are soaring based on the belief that AI will generate almost unimaginable future growth.
So the argument isn't that AI isn't real or important, just like radio was real back then.
Exactly. The tech itself might be revolutionary, but the market behavior around it, the intense speculation, the detachment from traditional valuation metrics, the fear of missing out, Sorkin sees that as eerily similar to the RCA bubble. He worries the current AI boom might be a sugar rush masking deeper problems in the economy.
Right. Is the excitement getting ahead of the reality, creating a bubble fueled by cheap money and leverage, just like in the late 20s?
That's the core question, and it's not just the specific tech. Sorkin's even more concerned about something broader, the weakening of the financial guardrails.
The regulations put in place after 1929 to prevent a repeat.
Precisely. Things like the creation of the SEC, the rules demanding transparency and disclosure from public companies. These were designed to protect ordinary investors from the kind of fraud and manipulation that ran rampant in the 20s. Sorkin sees a worrying trend towards rolling back those protections.
How so? What specific changes is he pointing to?
Well, there are a few things. One is that more and more big, fast-growing companies are staying private longer, so they avoid the strict SEC disclosure rules that public companies face.
Okay, less transparency.
Right. Then there's been an easing of rules around who can invest in these private companies and other risky ventures. Historically, access to things like venture capital or private equity was limited to accredited investors, basically rich people who could supposedly afford to lose their money.
Yeah, the idea was to protect mom and pop investors from super risky stuff.
Exactly. But now there's this big push, often framed as democratizing finance, to lower those barriers, to let more ordinary people into these potentially high reward, but also high risk, less regulated investments.
So the argument is, why should only the rich get access to the best opportunities?
That's the sales pitch. Let everyone have a shot at those huge private market returns. But Sorkin's warning is that what you're really doing is democratizing risk. You're removing the guardrails designed to protect people from blowing up their savings on things they don't fully understand.
And we're seeing this play out in real time with debates about retirement savings, right?
Yeah.
Like Larry Fink at BlackRock.
Yeah, that's a perfect example. Fink, who runs the world's biggest asset manager, is now suggesting that maybe traditional 401k retirement plans should be allowed to invest in things like private equity, infrastructure projects, maybe even crypto.
Whoa, that's a huge shift. Retirement funds have always been about safety and stability, relatively speaking.
It's a profound potential change. These private assets are often illiquid, meaning you can't easily sell them, and they lack the transparency of public stocks. Putting them into the core retirement savings of average Americans, that's basically mainlining the kind of risk the post-1929 rules were meant to contain.
And Fink's view on crypto has changed dramatically, too.
Right. He went from calling Bitcoin an index of money laundering to now suggesting it could have a role in diversified portfolios, almost like digital gold. When the head of BlackRock starts legitimizing crypto, it signals a major shift in institutional acceptance of highly volatile, speculative assets.
It all feels very frothy. And Sorkin has this amazing personal anecdote that captures the absurdity of the current speculative moment, doesn't he? The Sorkin coin.
Oh, yeah, it's priceless. He was interviewing Larry Fink, actually, and Fink joked offhand, maybe there should be a Sorkin coin.
Just a throwaway line.
It's just a joke. But within hours, someone online literally created a cryptocurrency called Sorkin coin, a meme coin, basically worthless, based on nothing.
And people actually traded it.
Traded it like crazy. At its peak, Sorkin says, this joke coin did something like $170 million in trading volume in a single day. Pure speculation, momentum, hype, zero underlying value.
That's insane. And what's it worth now?
He checked recently, about $20 or $21 total, not per coin, total. It's the perfect miniature example of the 1929 dynamic. Pure speculative frenzy based on nothing, followed by an inevitable collapse, leaving most people holding the bag. That's the kind of behavior that makes him worry history is repeating.
Okay, so Sorkin lays out this compelling narrative. 1929 was bad, here's how it happened, and look out, it could happen again. But we need to bring in some critical perspective here, too. His book, while lauded for the detail, hasn't been without criticism, especially regarding his interpretation.
Right, and that's crucial for a balanced deep dive. You need to consider the counter-arguments. Some critics, for instance, felt the book sometimes gets a bit too caught up in the quasi-pornographic details of the wealth, the yachts, the mansions, maybe losing sight of the millions who suffered in the depression that followed.
A focus on the glittering surface rather than the deep consequences.
Perhaps a bit. But the more fundamental critique, I think, targets Sorkin's analysis of the bankers themselves and his view of the market system overall.
How so? He calls them a gallery of rogues, which sounds pretty critical.
He does, but then he adds this qualification. He suggests that apart from the outright criminals like Whitney or Albert Wiggin at Chase, who famously shorted his own bank's stock,
Yeah, That was bad.
Right. But apart from them, Sorkin argues it's hard to say the other big financiers did anything appreciably worse than most individuals would have done in their positions and circumstances.
Hmm. That sounds like he's letting them off the hook a bit. Like anyone would have done it given the chance.
That's how critics read it. It seems to downplay their agency and responsibility, framing their greed as almost understandable human nature within a flawed system, rather than deliberate actions that harmed millions.
And this ties into his broader view of how markets work, doesn't it? He seems to believe that ultimately the system self-corrects.
That seems to be his underlying philosophy, yeah. He writes that markets are not contests of virtue and honor. The idea is that through the clash of self-interest, the market eventually, somehow, wins its messy way toward fair and reasonable prices.
So in that view, 1929, as horrific as it was maybe a necessary, albeit brutal, market correction, getting rid of the speculative excess.
That seems to be the implication. But critics jump on this point hard. They bring up John Maynard Keynes' famous line.
In the long run, we are all dead.
Exactly. The critique is that focusing on the market, finding some fair price in the long run, completely ignores the devastating human cost in the short run. The short run of 1929 was years of mass unemployment, poverty, and suffering directly caused by the market's failure. That's not just a messy correction, it's societal ruin.
And the critics also challenge the idea that the market movements in the 20s were just natural forces at work, right? They see more manipulation involved.
Yes, this is really important. The critical view rejects the idea that the Roaring Twenties boom and bust was just the market doing its thing. Instead, they argue it was a festival of fraud and theft.
Strong words.
Very. The argument is that the wild stock price swings weren't just about economic fundamentals or even broad investor sentiment. They were heavily influenced, if not driven, by deliberate manipulation, by powerful insiders, the Mitchells, the Morgans, the Pools, using their political connections and financial clout to inflate assets and then dump them on the public.
So less invisible hand and more rigged game.
That's the essence of the critique. The market wasn't some neutral playing field. It was an arena where political power and financial muscle determined the outcomes. The rules, or lack thereof, favored the insiders. Understanding that political dimension, the critics argue, is essential to understanding 1929 and maybe today too. Hashtag outro.
Okay, so wrapping this up, we've gone deep into 1929 through the lens of Sorkin's work and its critiques. What are the core takeaways for us thinking about the current financial landscape?
Well, number one is clearly the danger of leverage. When you have systems allowing massive borrowing against volatile assets, whether it's stocks on 10% margin in 1929 or complex derivatives or crypto today, you create inherent instability.
Right. Leverage magnifies gains, but it absolutely guarantees catastrophic losses when things turn. And the second big takeaway seems to be the seductive power of the new thing.
Absolutely. Radio then, AI now. There's always a narrative about a transformative technology that promises limitless growth, tempting people to ignore traditional valuations and pile in based on hype. That pattern seems timeless.
And maybe the most urgent lesson, given the current debates Sorkin highlights, is about that tension between democratizing finance and deregulation.
Yeah, that feels critical right now. The push to give everyone access to riskier assets sounds good, sounds fair, but it's happening just as the very regulations put in place because of 1929, the transparency rules, the investor protections are being chipped away.
There's a real danger that democratization becomes a cover for simply reintroducing the systemic risks that crushed people a century ago.
Exactly. And that leads us to the final thought, the tension to leave you with. The 1929 crash was so devastating it forced the creation of our modern financial regulatory system, the SEC, the Glass-Steagall Act initially, all those guardrails.
Right. The system designed to prevent it from happening again.
But today, driven by this desire for higher returns and broader access, we seem to be actively questioning and in some cases dismantling those very protections.
So the question we're left with is this current push for financial democratization truly about creating opportunity for everyone? Or is it perhaps unintentionally, or maybe even deliberately, a way to justify returning to a higher risk, higher leverage system where the potential gains are concentrated, but the potentially catastrophic losses are distributed much more widely?
That's the billion-dollar question, isn't it? Is history repeating, or are we smart enough this time to avoid the same mistakes? Something for all of us to think about.
Definitely food for thought. Thanks for joining us on this deep dive.
See you next time.